Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of InMode. What is InMode? Essentially, they're a global provider of innovative, minimally invasive, wow, what a mouthful, minimally invasive aesthetic and wellness solutions. Essentially, if you want aesthetic surgery or any changes like that, laser hair removal, liposuction, sort of a little bit of a facelift or skin tightening, they create machines that help the doctors do that. And essentially, the ones who are doing that are plastic surgeons, dermatologists, OBGYNs, ENTs, and ophthalmologists. Okay? And they are a company that is originally from Israel, but most of their profits come worldwide. So, yeah, let's talk a little bit more about them. So, their full year 2023 revenue is almost $500 million. They also happen to have a pretty positive net income. This is a non-GAAP measure, but their net profit margin is higher than 40%, which is very, very, very impressive. And they're selling in 96 countries. They have many units installed in the US and worldwide. So, as you'll see, there's some diversification there, 10 patented technologies, and 12 product families. So, here's everywhere where they're based. They have a corporate HQ, but they have all of these places with sales reps, with employees worldwide, and regional offices. So there you go. They are actually a global company. That's something also to note because given the geopolitical situation in and around Israel, there isn't really a country risk here. There is more of a administrative thing going on in Israel rather than an actual operational thing. So while Israel's economy is definitely not going to be great, especially not in the next couple of years, this company is worldwide, so they won't be affected by it. Now, they basically talk about this treatment gap where there's all these laser procedures, there's this plastic surgery. So one of them is very non-invasive, one of them is fully invasive, and one of them is not as expensive. The other one is very expensive. Essentially, there's a little gap here. So there's a place where you want to get results like plastic surgery, but without a lot of the shortcomings. You don't want scars, you don't want anesthesia, you don't want the cost. So here is what they serve, what InMode serves. So they're a business to business company, you'll notice, where the business is actually all those physicians, all those surgeons, those OBGYNs, ophthalmologists, etc. Those are the people they sell to. At the end of the day, what they want to address is that treatment gap. But those are their customers, and they want to have more physicians adopt their technologies. They want to have more sales reps pitching to the right doctors to get all of their different technologies. And let's look at all these different technologies. So they have all of these different things, body tight, right, which is to tighten the skin. They have things like the laser surgery. So if you want to remove bodily hair with lasers, then you can do that, and many other interesting things. So they basically create the machine, create the handheld devices. A doctor would buy that, have that, and then use that on patients. That's the pipeline. That's how they make the money. And obviously, these are patented. These are just theirs, so no one else's. That's InMode's business model. I think it's very interesting. I liked sort of looking into it. And here are the financials. So they have grown a lot, and they have grown very steadily. Look at how since 2016, they haven't really had a negative net income year. Even throughout 2020, I think that's the most impressive thing, is that people were still getting their cosmetic surgeries. So it's great. And their facilities are in the highest tax benefit zone within Israel. The company's corporate tax rate is expected to be 7.5 to 10%. That is tiny. So we love to see that. And their gross margins are between 83 to 85%. Their net profit margins, as we were saying, were in the 40% range. Pretty great so far. Okay, now let's look at more financials. So if we want to predict the future, which is what I want to do, I'm going to look at forecasts for revenue. And essentially, the revenue forecast for their guidance recently, actually, they just released quarter one earnings and their guidance wasn't great. So I'm going to go on Yahoo Finance. I'm going to look at the analysis tab where analysts are calculating the revenue. And I'm going to just take that low estimate to sort of go in hand with the lowered guidance and just say, okay, this is going to be the revenue for 2024 and 2025. I'm also going to calculate free cash flow here. So the way I'm calculating free cash flow to equity here is very simple. I'm grabbing cash from operations. I'm subtracting stock-based compensation. Why? Because it's still a significant portion of the cash from operations, enough to distort the picture. This is actually an expense. That's why I'm taking it out. And then you also subtract capital expenditures, and then you get free cash flow to equity. Now I'm going to compare the ratio of revenue to free cash flow to equity. So what percentage of revenue turns into free cash flow? And that turns out to average around that 31% number. It's 36.16. I'm going to take this outlier, this 45% out, and I'm just going to roll with this 32% number and just say, okay, in these future years, 31 to 32% of revenue is going to get turned to free cash flow. And with that, I can create this model right here, where I grab that. Those are the percentages for 2024, 2025, then 26 and 27. I'm just going to grow it by around 5%. And then after that, I'm going to have an 11% required rate of return and a 3% perpetual growth rate. I'm just saying you're going to grow at 3% for perpetuity, basically. And if you grab that divided by the total number of shares, the fair value for InMode is $24.44. However, we have to add or subtract the net debt. They have net cash. They have a ton of cash right now on hand. And adding that cash onto the valuation and dividing by the total amount of shares, the fair value is actually $33.17 with net debt included. So let's see where InMode is right now. Wow. Okay, so there's a massive gap over here. It's at $18.32, and the fair value post-debt is $33.17. Even pre-debt is $24.44. So this is a huge discrepancy here. And you'll see InMode went through such a roller coaster ride here, where in 2020 it was trading probably in the tens, and then it went all the way up to almost 100, then crashed back down, and recently had its little mini crash from the 40s all the way down to what it's now at, 18.32. The P close to 8, the market cap tiny, really. $1.6 billion is not much. And as you'll notice, they have in pretty much cash, they have half of their market cap in cash, which is pretty great. So this is pretty impressive overall. However, we have to talk a little bit about the risks. So the risks are that share dilution is real. They actually are not buying back shares. They're issuing more shares. And if they can dilute you or speed up that share dilution in order to raise money, raise cash, then you are having a stock that's worth less and less every time. So if you get diluted, that's a real risk. However, because of their net cash position, that sort of minimizes the fact that they could speed up significantly because they don't need cash urgently. Slowing revenue growth may also hinder enthusiasm for the stock. This is what you can see actually when they reported quarter one earnings. This happened over here, this little final descent. So it went from that sort of 21 level down to 18. So right now, there's not a lot of enthusiasm for that stock. So you may have to be patient. This won't go up in weeks, maybe not even in months. This will absolutely be affected by a recession. However, if there's a global recession and all of a sudden people don't want to do their aesthetic surgery, well, InMode is out of luck. And constant innovation will be necessary to keep up the growth. They have patented technologies, but there can be other players in the field. Maybe they don't have the exact same technologies as InMode, but no one says they're not able to be disrupted. However, the rewards here are the strong revenue, net income, and free cash flow growth. They're great numbers. Lots of cash on hand, no goodwill, which is amazing, and potentially very undervalued considering the large cash position, but that depends on how flexible the cash is to spend. There's still plenty of room to grow with more adoption by doctors worldwide, and amazing margins and tax advantages will bode well for further balance sheet strengthening. So this is basically the all in all, and I wanted to present the risks first because of this reason. So I want you to analyze the potential risks first. The reason why is because it's great to see in this valuation being like, wow, there's such a gap between the price and what it's worth with these assumptions. However, what we want to see is, knowing that, let's list out all the risks, and if that still fits my portfolio, if I have an appetite for all these potential risks, then it can fit my portfolio. Then it can be an investment worth making. I think it's a very interesting company. I'm definitely going to keep an eye out on it, especially now at this $18 level. because the gap is getting just a little bit too insane. I think there's definitely a buy point here, just as there's definitely a sell point. You cannot let this be 100 when it's not making even close to that in free cash flow. So, there's a buy and sell level. There's something where the risk is just not nearly justified, and there's some levels where the risk is too much. So, analyze the potential risks first, and then see if this fits your portfolio. And if it does, I hope it does well for you. With that said, thank you so much for watching this whole video. If you like this kind of content, don't forget to like and subscribe, and I'll see you on the next one.